India strategist at Jefferies. And Mahesh is joining us on the program after a long time. Mahesh, it's great to have you with us here on CNBC TV18. Appreciate your time here, as always. Your first thoughts, Mahesh, on how you're seeing markets after, the recovery, the run-up that we've seen recently, and also contextualizing in the face of the U.S. market giving up almost 60% of its recent run-up.
Yeah, hi Prashant. Thanks for having me here. It's always a pleasure. See, the thing is, I have been cautious, on the markets for a while, but obviously the markets have moved up, since then. And I can clearly see the momentum in the market is very strong at this point in time. We're seeing very, very strong foreign inflows coming through. Domestic flows maybe ease a little bit, but still quite strong on an absolute basis. And most of the fundamental parameters of the economy are also doing reasonably well. And also from the international standpoint, within the emerging market context, India is becoming more and more, a TINA factor, because many other emerging markets, are kind of falling out of, flavor for the international investors. So a lot of positive things coming up, for the market. So in that context, it's difficult to still maintain, a cautious view. But I think, from a medium-term perspective, from a 6-month, 12-month perspective, I would still reiterate my, cautious view here, because, while the corporate earnings are doing reasonably well, the economy is doing fundamentally well, but I think we need to differentiate between market movement and the economic fundamentals. These two are broadly correlated most of the times, but not all the times. And especially with what is happening globally, especially in the US in terms of the rates going up, the Fed balance sheet shrinking, etc., the dollar strengthening, all those things are definitely, not very supportive from the valuation standpoint. So I would still maintain my cautious view here.
Okay, Mahesh, good morning. Slightly different from what your colleague Christopher wrote, right, about at least the point he's making is that making China a bit neutral once again and allocating that money to India. And the big debate has been on fund flows, because we've started to see some amount of FI inflows, and it looks like a lot of this is strategic in nature, with money moving out of China back into India, which was perhaps not the case about 3 months back. But do you think that can continue, and maybe that will hold the market in good stead, valuations notwithstanding?
Yeah, so that is what is happening to some extent, Anuj. In fact, what has also happened within the emerging market context is that over the last 12 months, there have been 2 such occasions where people actually moved the other way around. That is, took money away from India and put more money into China. That happened once about 12 months ago, back in October last year, then again in May, June this year. And both these times, the investors did not really end up making money. So they really have a bad taste about going overweight on China. And India, by all means has done, very well economically, fundamentally, and, from the stock market movement perspective as well. So there is clearly that, force or, that factor to keep in mind. So as I said, from the momentum perspective, things are clearly in favor of the Indian markets here. But as I mentioned, valuations are becoming more and more uncomfortable. And as Prashant also mentioned, especially in the context of US, also we have outperformed quite a lot. S&P, is kind of down almost about 15% YTD. Our markets are just about flat. And even more so, the difference in terms of, in terms of NASDAQ as well. So, I basically believe that right now India is clearly benefiting from that TINA factor, as I mentioned, that many of the large emerging markets are not really finding, positive, kind of flows from the international investors. And, we're actually seeing that after a long gap of nearly 8-9 months, where we consistently saw about $4 or $5 billion a month kind of net selling. The last 1 month has been very strong. But I don't want to take that flow for granted. That's what I can say.
Okay. Well, for now, a lot of stocks are hitting fresh highs, so let's just spot them. ITC is at a fresh 52-week high this morning, and the stock is at a dream run this year. It's up almost 50% for the year. Ashok Leyland is at a fresh 52-week high as well. So is Indian Hotels. Mahesh, good morning. How do you identify the next big trend for the market? I mean, there is a theme that's playing out, which is domestic consumption, whether it's autos, whether it's hotels, FMCG. Do you think that's a structural story or anything else that catches your eye now?
Yeah, I would say domestic consumption, is a good story. So even in the context of, my cautious views, I would say that these sectors, basically whether the domestic, staples or the discretionary consumption, be it hotels or, be it some of the other names like autos, I think domestic consumption, looks like a pretty strong story to me. Staples, while it still has some issues, pertaining to the rural demand, which hasn't really picked up as well as the urban demand has. And, there are some cost pressures there, etc. But, I feel that it's a good defensive bet to take in the environment, especially if you think the markets are going to be stable to maybe, even downward moving. I think staples makes, a lot of sense according to me. And so does these urban consumption stories as well, like hotels and autos. So I think that's clearly a strong overweight for us.
But take take HUL as an example, right? Stocks up some 40%, I think this year, despite earnings downgrades over the last 2 years. And there is also a history of companies giving back some of these price increases when commodities start to turn lower. Your sense with these factors in mind, staples specifically, Mahesh?
Yeah, staples specifically, as I mentioned, there are these issues pertaining to the rural demand side, and I think what the companies are trying to do at this point in time is take price hikes to pass on the costs, and maybe do a bit of a savings on the A&P expenditure as well, and that's how they've been able to maintain their EBITDA margins and report PAT growth, which is reasonable. My sense is that going forward, especially and as we look at the next 6 to 12 months, where the inflation is still going to stay high, the nominal GDP growth is going to be staying elevated at somewhere between, let's say, 13-14%, maybe 15% as well. So that's usually a good environment for some of these staples companies, because they can report a higher nominal revenue growth and a higher nominal PAT growth. And as I mentioned, they have also been proved to be good defensives. So if you look at the last 12 months, there have been about 2 or 3 rounds of corrections, with the markets correcting by almost 10% in each of those 3 occasions over the last 12 months. And practically in each of those 3 occasions, FMCG or the staples have ended up outperforming. And that's what I believe will happen probably over the next 3 months as well.
Okay, that's on staples. Which side of debate are you on in the IT space, Mahesh? Because there's one view that now with margins back to pre-COVID levels, valuation still 40% higher. Maybe they need to correct more. On the other side, there's a belief that the growth still quite clearly visible. Maybe this is a good time to get in. Your thoughts?
Maybe this is a good time to get in if you believe in the continued market strength, in India and probably also globally. But increasingly, Anuj, and especially if you look at the comments made by the Fed last week, they clearly seem to indicate that they will do whatever it takes to get the inflation down. And I think that sort of commentary would be associated with more rate hikes and I would say a greater probability of hard landing in the US economy. I mean, our own house view is that the current US unemployment rate, which is at about 3%, it's impossible to achieve a 2% inflation target with this kind of an unemployment rate. And, our house view is that the US unemployment rate needs to go up for the wage pressures and the broader inflation expectation in the US economy to come down. And I guess the Fed will have to act towards that. So if you keep those things in mind, and if you keep in mind the impact that it will probably have on the demand side or on the commentary, I believe that the risk reward is not really favorable for the IT services sector, especially because as you rightly mentioned, the valuations are still very, very steep, and there is a possibility of some small disappointments coming through, if not actually on the numbers front, but possibly on the investor sentiment front, especially if the US Fed keeps tightening.
Okay. There's a lot happening in the defense space, and I know it's a very small part of the overall market, but, the next company that we speak to also is doing something. They're building a warship, which is Cochin Shipyard. You have BEL, which has done exceptionally well. You have HAL that has had, a dream run. It's doubled in the last 12 months. Do you see any value here for long-term investors, or would you stay away?
No, I think defense and, broadly speaking, I would say the capital goods sector in general shows pretty strong promise, I would say. And while we might still be away from, away by a few quarters from the broad-based capex cycle recovery, etc., but there are many segments like you mentioned, defense. Then there is industry automation. And then there are some ESG-related capex plays. So I would say that many of these companies have also been reporting good numbers. In fact, in the latest quarterly result season, some of these capital goods companies actually stood out as very few exceptions, where we saw earnings upgrades, while most of the other segments of the market saw downgrades. So I would say selective picks in the capital goods sector is still the right strategy in my view.
Okay.
You could look at, apart from logistics, apart from defense, you could look at some of the logistics names and some automation capex related names as well.
Okay, well, logistics, automation, capex, those are some big themes actually that have played out in the last 1 year. Thanks a lot, Mahesh. Appreciate your thoughts. Thanks for joining us on CNBC TV 18. But let's take that discussion forward. In a proud moment, India's first